Hello and welcome to our conversation on accounting. In this presentation, we will discuss two important things relevant for analysis of financial statements. Number one is the understanding of the cash flows and observing the change in the cash flows with the change in the book value per share. To do that, we'll pick up financial statements, the balance sheet, income statement, and cash flow statement. So already the transactions have been converted into financial statements. Let us just observe these financial statements and get some understanding about the cash flows. For example, we can have some questions. The moment you see the financial statement, some questions should immediately come to your mind. What is a book value per share? And we can see that one by one, the book value per share was 35 and has become 40 by the end of the year. So how did the book value per share go up? The book value per share we know is equity divided by the number of shares. The number of shares is constant and the book value has gone up because of the equity. And equity has increased because the reserves have gone up, and the reserves have gone up because the part of the profit has been retained by the company. So the equity has increased from 35 to 40. What happened to the earning per share? The earning per share is 15, the number of um, PAT divided by the number of shares, profit after tax divided by number of shares. Now observe that the company has earned profit. The book value per share has increased, but you can see that cash has come down from 75 to 2,600. So the question should be, why did the cash change during this period, despite the fact that the company is making profit? So it is necessary to understand the reasons for the decrease in the cash. To understand the decrease in cash, it is always important and relevant to fall back on the cash flows as defined by the Ind AS 7. Now, if you observe the cash flows as per the Ind AS 7, we can understand why did the cash change. So, for example, in this case, the cash flow from operation is 80,000. How did we get that? Is cash sales plus collections minus operating expenses and operating payments like salary, creditors, and the tax. In this case, tax has not been paid. And the CFF, which is cash from financing, is negative because we can see the reasons for the negative cash flows, where the company did not raise any cash flows from the capital or the loan, no change in the capital, no change in the loan. However, the company paid interest and dividend. Interest and dividend. And CFI is nil because the company did not make any investment, neither it has received any income from other sources. So therefore, we can see that cash has come down from 75,000 to 2,600, mostly because of the negative CFF. But observe, the focus of our discussion is to understand the cash flows. Let us understand each component of the cash flows better. And one of the important items in the cash flow analysis is to see the CFO's cash from operating activities. The cash from operating activities is 80,000. So there has to be a question that why CFO is not same as profit. There are no other incomes from the operations. Only expenses, majority are the operating expenses. Why is the company's CFO not same as PAT? And to answer this question, it's always better to find CFO by using an indirect method as suggested, as prescribed by the Ind AS 7 and also AS3. So we know that profit is not equal to CFO because of non-cash items, because of non-operating items, and because of the changes in the operating cash working capital. So let us see whether what are the non-operating, non-cash, and the changes in the operating working capital. So the depreciation is a non-cash item. We adjust for that. Interest is a non-operating item. So we add it back because it has been deducted while computing the PAT. And then we'll see the changes in the operating working capital, that is decrease in the creditors. So that means the creditors have been paid and that has not been recorded in the income statement while computing PAT. We are not required to record that because every payment is not an expense. In the same way, the tax payable, increase in a tax payable. What does that mean? The tax which is shown in the income statement has been deducted while computing the PAT. However, the tax has not been paid during the year. We can see that increase in the tax payable. We can also, of course, see from the cash flow statement the tax has not been paid. So therefore, we adjust it by adding it back. The increase in the receivables, it's an important item which is responsible for the cash not being equal to the profit. So we can see that the receivables has increased from 15,000 to 305,000. Why did the receivable increase? So increase in receivable means that we have not collected money from the customers whom we sold goods on credit. So let us see what is the credit sales here. The credit sales in this case is 450 minus the cash sales. So 300,000 is a credit sale. A significant part of our sales is a credit sale. And moreover, we also collected only 10,000 when there is an outstanding or receivable is 15,000. So that means during this period, a significant part of the sales were on credit, and we have also not collected fully from the old outstanding cash receivable. So because of this, profit may be positive, but the CFO is not exactly equal to PAT to a large extent because of the credit sales or because of the increase in the receivable. So whenever we try to understand the financial statement, observe what has happened to the book value, what has happened to the earning per share, and what is the cash flow from operation per share. But you have to remember, these numbers will be meaningful provided you undertake an intra-company and inter-company analysis. Otherwise, just by observing 40, 15, and 5 is not going to send a signal, is not going to tell us much about the company's financials. However, let us see different cases, different situations with these big book values, earning per share, and CFOs by making changes in the financial statements. Now keep a watch on the book value, EPS, and CFO. Let us go down and observe now the book value per share. In this case, you see the PAT. PAT is same as the profit after tax in situation 1. The earning per share is 15. The earning per share is also 15 in this case. Okay, earning per share. The book value per share in this example has increased. The book value per share has increased from 55 to 70. The book value per share has increased, but increased by from 35 to 40. So therefore, you can see why this has increased. Let us examine why the book value has increased by 270. But you should also be careful about observe the cash flows. So in this example, the cash flow from operation is negative. Same profit, but negative CFO. So let us have the questions first. The book value has increased from 55 to 70. That sounds good. However, the cash flow from operation has actually become negative or is negative. So why is the cash flow from operations negative when there is a huge amount of profit, which we saw in the previous case that the CFO negative is significantly because of the increase in the debtors. Increase in the debtors means the credit sales. Can we see the credit sales here? The credit sales will be equal to the change in the, you can see that credit sales is 450. Why did the receivable increase, right? The receivable increased because entire sales is on credit and we are not able to collect the full amount of receivables for the previous time period. So even if the book value has gone up from 55 to 70, one needs to be careful about this company because the company is not able to convert the profit into CFO. And moreover, the CFO is negative here. That is more a worrisome factor. And if a company consistently have negative CFO, then definitely it is sending a signal that the company's inability to convert the profit into cash is not happening. Or in other words, the company is selling goods on credit and is not able to collect the money from the debtors. Does that mean that collection, does that mean that credit sales is not good? Of course no. The credit sales is not bad as long as we are able to collect the money from the debtors. But if the debtors keep on rising as it is happening here, then it is a matter of concern. So don't just observe the book value per share, also observe the CFOs and earning per share. In this case, intentionally, I kept the earning per share constant and we are observing the change in the book value per share and the change in the cash flows through the CFOs. Here also, you observe the company made a small investment. There is nothing much they have created any new assets, no change in the plant, no change in A shares, a small investment in company B. And observe this, the company B is a company where they have full control. What does that mean? That means in B is a subsidiary of the present company ABC Limited. So suppose this is the balance sheet of ABC Limited. Okay, ABC Limited. So B is a subsidiary of ABC. So B is fully controlled by ABC, and in that they made a small investment, increase from 50 to 80,000, and therefore CFI is negative because the company made a cash outflow by purchasing the shares of B. Keep a watch on this book value per share and CFO per share. Let us go to the third situation. We are not making any major change in the financials except the change in the book value and the cash flows. Observe, let us observe. The PAT is same. Earning per share is same. The CFO is the same negative. And the book value per share has come down. In the previous two cases, the book value has gone up from 35 to 40, 35 to 70. But now the book value per share has decreased from 55 to 30. Why did it decrease? It decreased because the equity has decreased. But why did the equity decrease? Because the company paid a dividend. It's not a problem because the company is having profit. There's nothing wrong in distributing dividend. But where is the cash coming from? Observe, the CFO is still negative. CFO is still negative. So 255,000 is a negative CFO. The credit sales is 450,000. We are not even able to collect fully the old data. So obviously a question comes to mind, where is the cash coming from to pay the dividend? And observe that carefully, the cash has come from the increase in the loans. Okay, let me highlight it, increase in the loans. So the company has raised money, okay, by taking a loan. So therefore, the dividend payment per se is not bad, but the dividend payment in this case seems to have happened by raising money through loan. You can ask a question, how did the banks give loans to this when the company is not able to generate CFOs? So maybe banks might have operated hands in glove with the company. We don't know. We need to examine. Maybe the banks themselves are thinking that ABC is a very important client for them. We are not getting into the bank's balance sheet now. But it is a matter of concern that the company is having negative CFO, and also the book value has come down, and the book value has come down because of the payment of dividend, and the dividend we are able to pay because the company has taken big loan. Observe how much dividend we paid. We paid dividend of 600,000. The investment of the shareholder is actual investment. The initial investment is 150,000. So in 1 year, the dividend has been paid is 4 times of the capital of the company. Okay, so therefore it's necessary to observe that why the book value has come down. The book value has come down because the dividend has been distributed. The dividend distribution has happened by raising money through the loans. And observe that loans have increased. The loan has increased from 20,000 to 520,000. You may ask, but the interest is same. Is there no change in the interest for the previous period? Same interest, 20%, 20,000, 12%. What does it mean? It means that the loan has been taken at the fag end of the year, and the interest burden will be visible next year's financial statement. Who knows? The profit itself may become negative in the next year. So that may be sending a very important signal. Why is the company borrowing money when the CFOs are negative? And more important, if the cash is not there, why is the dividend been paid when by borrowing money? Okay, so we're able to see that the same EPS, the change in book value per share, examine why did the book value per share is changing, and link it with the cash flows, because the cash flows are actually the operating efficiency of the company. And within the cash flow, always keep a watch on cash flow from operations. Now, let us see the fourth situation. In this case, first let us see the book value per share has gone up. Even if CFO is negative, book value per share has gone up. So therefore, the relevant questions for us to examine, always you should have questions in your mind when you observe the financial statement. If you have no questions, no financial statement analysis. So the book value per share has increased, very good. CFO is negative, okay, not a problem. If I'm able to collect that money in the next time period, so for that we need to undertake intra-company and inter-company analysis. So let us see what happened to the book value. The book value has increased because the entire profit has been retained by the company. No dividend. No dividend. But how did the book value increase? Isn't it? Because equity has gone up. But why did if the equity has gone up, that means the entire profit has been retained. Okay? The equity has gone up because entire profit has been retained. So, and observe this, what did the company do? The company in this case also has borrowed money, 5,500,000. And what did they do with that increase in the cash flows? They raised money, you can see that. They raised money through the loan. But what did the company do with that loan? In this case also they raised money. But now they raise money to invest in B, where they have full control. So let us put the numbers together. So the point that I wanted to drive in here, you are seeing that cash, the company has raised money, even if there is a CFO negative, and the book value per share has gone up. That sounds interesting and good. What did the company do with this new loan borrowed? The new loan that they have taken have actually invested in a company on which they have full control. So there is a CFI negative. The CFI is negative because they purchased B share. That sounds okay. But observe, what is this B? B is a company where ABC is having full control. So therefore, try to reflect on this. The company's CFOs are negative. That means that is not able to convert the profit into cash. The company borrowed money and used the money not to pay the dividend. That's good. But instead of doing that, they invested that money in a company which is on which they have full control. So is it possible that the company is actually transferring cash to their related party because it is a company on which they have full control? Worth examining and observing. Several companies have been doing this, transferring cash flows from the parent company to the subsidiary. And many subsidiaries may be unlisted, related companies through ownership, or related company because the directors have control on them. So it is necessary not just to observe the book value and the CFOs, but also observe where is the cash going. So always making a careful examination, undertaking a careful examination of cash flows is a very, very important skill that you need to develop while examining or undertaking financial statement analysis. But hold on, borrowing money per se is not bad. Making that investment is also not bad, but you invested in a related party, raises question. But suppose, let us say the another situation. In this case, we have more or less the same case. They borrowed money. CFO is negative. EPS same 15. Book value per share is same 70. But observe, the company did not make an investment in B. The company invested in a new plant. Okay, so here also the book value is 70, but they invested in in a related party concern where they have full control. But here they invested in a new plant which will be operated by ABC itself. Now able to see? So it is not just the numbers which will tell you what is happening there, but you have to also understand the context. Examine the number. Now first, observe the interrelationship between the financial statements. Understand some important numbers like book value per share, earning per share, and cash flows with a focus on cash flow from operations. Then examine why is the cash changing. Examine why is CFO not same as PAT. Why is the book value increasing or decreasing? Is the company transferring, removing cash from the company and distributing in the form of dividend? Or is the company transferring the cash to another subsidiary which is a related company? Or is the company actually creating cash flows, future cash flows, by creating investments in a plant and property or equipment or investment in the research and development? So therefore, financial statement analysis to a large extent depends on your ability to understand the interrelationship between the financial statement and raising a pertinent question, and understand the signals that the financial statements or the numbers are actually giving to the market. So to recap and say that our objective was to understand cash flows and its relationship with the book value per share. Observe, pick up the financial statements of any company, observe the changes in the cash, observe CFOs, CFIs, and CFFs, and see how is the book value is getting affected because of the change in the cash, change in the cash flows. Thank you very much. In the process, we are actually not only able to understand what is, thank you very much.